Bridging has never been more competitive. I think we will agree we've seen a lot of new lenders in space over the last 2 years or so, and more coming in frequently. What impacts could an increase in bridging lenders, which have historically focused on bridging but are now diversifying into other areas like buy-to-let, have on these respective markets?
I think there's a number of lenders that have probably looked at going into buy-to-let, I think ourselves included, but saying, well, okay, if we did go in, what's our niche? What's our USP? Because, margins are compressed. Absolutely.
This is an issue because even in the bridging market, the talent pool is being stretched thin as it is because it's such a competitive market. Like if we're seeing lenders diversifying because of the competition, is there enough talent in the market to recruit for those product sets?
I would say no.
I don't think there is.
And I think that's where lenders are falling down, or ones that are trying to, innovation is going to be key for any lender to be successful, and that's going to be whether they innovate with products, criteria, or
systems.
Technology. Systems is a big one. Somebody could come in, look at the new technology, look at open banking, how can they utilise that with their processes, and if you can differentiate by service, you can charge a premium for that, and you can then maintain those returns that bank needs. Because I think we were talking about margin, they've been compressed. That's why we are seeing some lenders go. They're actually looking at it now thinking, is it worth it?
The buy-to-lets coming out of bridging, because of how the due diligence we do on those cases, we make sure that there is an exit before we would do the bridge. So if we haven't got a solid exit, we're not going to do the bridge. So we've always had a very good 100% conversion rate from that bridge to buy-to-let exit. Conversion rates are good if you do the job properly.
There's definitely more of a need for the refurbs term products. So for the consolidation for lenders, I think could be a very good thing. Because clients need that. When they're borrowing typically for refurb projects, they want to know that they can exit, but on the increased value on the GDV. And if you're dealing with two separate lenders, typically those lenders will not want to lend against the higher value. They still want them to have some hurt money in there. So it can get a little bit more complicated. So if anything, the consolidation side would be a great thing, but I think it goes back to what everyone else has been saying, that it needs to have the right processes. You still need to have your bridging underwriters, you still need to have your term underwriters. There's different risks for both.
I wonder whether from a broking perspective, often that's a question that we would put to our clients, that if you take this bridge and we flip it into a term product, that this potentially is not going to get you what you want when you actually want it. Yeah. So this is what we can do to get you your asset to purchase, and then this is what we can do further down the line. I think it's a fine line between getting it right from a lender's perspective, because you do have to underwrite two completely separate products, and whether or not the broker can impact on how successful that is across the market. Sure. Because you want to protect your client in terms of securing their asset, and you don't necessarily want to have to explain to them and for them to understand that this can be an elongated process because of actually what you're looking for.
There's also the fact that product, that end product, the exit product, in 6 months' time, picking a date in the future, is that going to be the best product for that client at that time? So there may be something better. So having the option for it gives you the certainty, but to be fixed into it is not what you want, because to the best of the client, because there could be something better coming out in 3 months' time because of competition, etc., that you really want to put that client into it.
I mean, we do lots of bridging that when it comes to it, we flip them straight into a term. We don't advertise it as a product, but we do it all the time. They're in the bridge, we've got the bridge done within the timescales that they wanted, but they're coming to the end of their bridge, we'll say, okay, would you like to now go into a term? That allows the broker to source the market as well and say, actually, I can look at this and I can now compare it, and my client is free to go wherever, but actually they're in-house already. The reduced fees because we're just switching them into a product. So I think this has been going on for a long time. As soon as you try and wrap it up as a product, like you said, you're then looking at the underwrite for a term deal right at the beginning. You kind of lose why you're doing the bridge in the first place.
But what you look at is a reasonability. Is it reasonable that this individual is likely to get, and you work with the broker and you work with the customer and you say, well, okay, in 5 months' time, 6 months' time, 12 months' time, who are you intending to go to? And you have a look to see whether that's reasonable. Now, I would accept the fact that if somebody has a choice of one, all right, then you have to question at the outset of the bridge whether this is in the person's best interest anyway. But it's not usually the case.
There is clearly a race to the bottom on rates in both bridging and in the buy-to-let market, and obviously that is not sustainable. So I think in the current economic climate, the political climate, then these institutionally backed lenders are going to see their funding lines getting pulled, and the institutions are going to be cautious before the front men are. And I think what we'll see is that exits will be more difficult to attain in the coming years, and ultimately we've seen bridgers going to 85% loan to value, 100% of purchase price, and I think we'll just start seeing a natural retraction in the loan to values offered and getting the gearing right to make sure the exit is available.
I think there will be more products that will come to market which will have elements of interest roll-up and serviced as a blended product, because I think there is, you know, we did do that at Castle Trust, and for the right clients, especially portfolio landlords, I think, so you're kind of blending the two, so that the rental yield will work, or if it's a low rental yielding property, that would work. I think that's a kind of hybrid product that would take off.
From the development side of it, you're looking at development exit ones, so that if the developer has, and the market's gone against him, and he's going to hold it and do buy-to-let out of it and go and flip it into buy-to-let. But again, it's back to how big that market is.
For lenders looking at products in different areas, I think it's important to bear in mind what the overall security package is, different routes for enforcement, and so on, because on one hand, it's not easy, but it's in theory it's possible to put together various products. But if lenders aren't aware what the outcome of those might be, or where there might be some issues as regards security or enforcement, then things may come as a surprise, during the course of the loan.
And as long as you are setting your stall out correctly in the first place, okay, making good lending decisions, lending to the right people on the right asset classes, you're unlikely to go too far wrong unless you are too high on your gearing. Gearing is the thing that that lets me sleep at night, okay? Because if you're in a market that's continually rising, okay, you can maybe take a view on the level of gearing. But in a market that's uncertain, particularly in the short-term space, gearing is your friend.
Well, obviously we've got Brexit looming. I've got investors that are sat hungry, looking at a possible drop in the marketplace. And if they are switched on and they've got a low geared portfolio, they'll be absolutely fine and they'll be able to make the most of the opportunity.
Yeah, I think Brexit will do the other thing. I think we'll see a lot, I know I keep going on about this, but I think we'll see a lot of funding lines collapse because of the uncertainty.
Are lenders not prepared for that? Because the amount of lenders I speak to have got 5, 6, 7 funding lines plus, are they going to be protected?
It depends where the fund, what we said earlier, it depends where the funding's coming from, and that's where, when you asked about Simon's panel, our panel, we do due diligence on them, where's the funding coming from, so you are protected, otherwise you're putting your client and your business at risk. Should a bridging underwriter know about the buy-to-let exits in utopia land? Yes. Where you've got both of those products in the mix, like yourself, Alex, then yes, it makes sense. But for a bridging lender that doesn't do buy-to-let, how can they?
It's our responsibility to make sure the exit is going to work as well. So it's all well and good us hoping that we can rely on the BDM or the underwriter from our bridging lender, but we need to know where we can find the expertise if it's not there.
I think a good broker, a good packager, you can almost pretend that the underwriter for the lender isn't there, because if you're worth your salt, then you should know what you're putting together is going to be exactly what that lender wants to say.
Whilst I think it's really good to have a direct line if you need to the decision maker, you don't want to detract them from what they do day to day. It just causes delay in the cases, and every broker under the sun, like some of them aren't on top of it as they should be, so they would literally rely on the underwriter all the time. That can take their time away from it. So having a BDM that understands the underwriting side and the specialist side that you can go to should you need to, and you know that they can get it done. You don't need to have constant direct access to an underwriter. It's just a nice to have.